Okay, good morning. July 15th, weekly meeting. Okay, I want to talk about a trade setup that we took, or I took. I kind of brought it to you guys' attention. Hopefully you guys took the trade. This was a sell opportunity last week. You can see it created this red candle. We were anticipating the sell based off the bearish OB the previous week. I want to drop down to the 4 hour. Actually, I'll just drop down to the 1 hour because this will allow everybody to kind of see what happened. And then we're going to watch a video. I'm going to mark the beginning of the week. Sunday, 1700, 5 o'clock New York time. This was the beginning of the week. Okay, I'm going to point some things out. All right. This was the last high that price came from. It pushed down. The week closed when price was down here. We expected price to push back up. And then we expected price to collapse. Now, if you throw a fib from this high to this low, you're going to get close to an optimal trade entry. It's very important. One of the concepts that will be discussed this week. So on the 1 hour chart, you can see that pullback being close to a 78. It was a pullback that we expected. We talked about it. We talked about coming back to this level. You can see price push right back to the level. And then price collapsed the entire week until it reached the low. Then it pulled back up, right? It broke these highs right here, broke this high, it broke this high, it broke this high. It's letting you know that this is a change of character on the 4 hour. Now it's going to pull back and then we'll go the opposite direction. Okay, this is a brief analysis that I did on a 1 hour chart based on price action. Okay, if you know how we trade the weekly candles. So if I was just trading a weekly candle, I got to get rid of this blue line so I can actually see it. I could fib the weekly candle and get the pullback zone, you know, for the weekly move. And if I do that, here's the 62. Here's an area of interest here. Here's the 78. Okay. Price could even pull back up, maybe and challenge, you know, or get close to the area that it started. But if we just wanted to trade the retracement, here's the golden zone. Here's the 78. There are several areas of opportunity. If we drop down to the 4 hour, we look in our zone, we have an order block here. We have some imbalance. We got another order block here. We have imbalance. Okay. I pointed some things out on the chart. Now I want to look at two different videos. All right. The videos will basically explain these concepts from the proverbial horse's mouth. Okay. All right. This first video we're going to look at is a 20-minute video on the power of three. This is basically the concept that we've been using to trade the weekly candles since you've been in this group. All right. Some of you may have seen this. If you see it again, you'll probably get a little bit more out of it. For those of you who have not seen this, this is a great opportunity for you to understand or get a better understanding of what we are trying to accomplish every week.
Manipulation, and distribution. Okay, the ICT concepts used in this module. The ICT power of 3. Importance of developing anticipatory price skills. Engineering liquidity in the market. Neutralizing liquidity in the market. Market making and pairing of orders. What accumulation looks like in bull and bear conditions. Where does manipulation occur in bull and bear conditions? What distribution looks like in bull and bear conditions. All right, so we're looking at a crude depiction of a open, high, low, close bar. And for the purposes of this teaching, every individual bar or candle is going to be referred to as a daily range or daily bar. Okay. Now, everything I'm going to suggest to you here is applicable to every time measurement. Okay. In other words, every time interval, if it can be charted, this same phenomenon or concept can be applied to it. So regardless of what time frame you can pull up and form it into a chart, as long as you have a beginning time, the highest value, the lowest value, and an ending in terms of measuring time, this concept is applicable. Okay, but for the sake of our discussion here, and for something that you can practice and look for a few times a week, the ICT Power 3 is basically a concept of looking for accumulation, waiting for manipulation, and then looking for a period of distribution. Now, I look at candlesticks because it helps to be able to see after many years of looking at price action. It's very hard on your eyes. As long as I've been doing it, staring at it, spending lots of time in charts, both on a screen and on paper, I can see that my eyesight has diminished over the years. One of the benefits of knowing what you're looking for is spending far less time in the charts than most traders that, like me and before me, we spent a lot of time researching and looking at things. So I gravitate towards candlesticks because it's easier on the eye. Not that there's any magic behind it, but the same concept that's seen here with a bullish open, high, low, close bar to the left is comparable to what you would see in a bullish close candlestick. Much, much easier to see by staring at that versus that little tick to the left or the little tick to the right that distinguishes the open and close on individual candles or bar. Okay, so back to our discussion. Using the open, high, low, close bar, it's going to be a lot easier for me to describe the phenomenon that makes up my ICT Power 3. And the origination behind this idea was inspired by my mentor, Larry Williams. He made a point in one of his lectures that he ended up repeating several times for a number of years, but he made a point of making a remark about he wished he knew how the traders or who the traders were that could be buying below the open or selling above the close on bullish or up close days. And I took that as a personal challenge, and I spent the first quarter of my 25 years mastering just that concept, because I felt that it was enough for me to work towards, cracking that code, if you will. And I think I've done it. I've taught it to other people, so I know that it's something that is real, it's tangible, it can be repeated not only in my own results, but other people that have learned from me. But it all hinges on the reference point that starts our time interval. And again, we're referring to every bar or open, high, low, close bar depiction in my diagrams as a representation of one daily bar. Okay, so a full 24-hour period. It does not matter that if it's forex or commodities or bonds or whatever it is. If it's a market and it can be measured in time intervals, the highest value, the lowest value, a time at which it starts trading and a time it ends trading, you only need those 4 reference points. So the open, high, low, and close is all we're concerning ourselves with here. Now, the first of the four is the opening price. Now, for definition terms, this is the initial value price prior to any imbalance. And I'll talk more about that as we go. The closing price is the ending value price post-price imbalance. Okay, the portion that makes up the range between the open and close is referred to as range expansion, and this is a dynamic price imbalance. Now, this can be a bullish or bearish imbalance relative to the open, but for example's sake, our first one's going to be referring to a bullish up close. So this would be a bullish range expansion or a dynamic price imbalance of a lot more movement to the upside, seeking a higher price above the initial value price of the opening price. In layman's terms, we're looking for a bullish close. Okay, now as far as it goes in terms of accumulation, manipulation, and distribution, or power three, the first thing we have to determine is what is accumulating. Now, if we're bullish on the marketplace, we would be looking for accumulation in the form of long positions building up. It's going to be around that opening price, and I'll talk more about the opening price in future tutorials. But the opening price, just above it or below it when we're bullish, that's where longs are accumulated. Now, who's accumulating those long positions? Smart money. When we're bullish and we're anticipating a bullish range expansion to the upside, okay, or a higher close, we would be hunting a manipulation cycle immediately after the opening price. So on a daily range, that opening price, if we're bullish, we want to be buying at that opening price or below it ideally. Why would we want to be buying below the opening price when we're bullish? Because the market makers are going to be looking to engineer short liquidity. What does that mean? If a market breaks quickly below an old low, there are traders that look to be a breakout entry. So they'll look to sell short on a stop. This engineering forces liquidity in the marketplace to sell at a very, very low price. That run below an old low or a quick sudden movement will entice traders that are on the sidelines just watching price. And you know what that feels like if you watch lower time frame charts. Any sudden move lower, your heart starts to have palpitations, you get excited, you think it's going to keep going lower. What happens? You take the bait, you go in there and you sell short, and the market stops on a dime, reverses, and goes north. Immediately below the opening price on the daily range, when it's bullish, this initial drop down is very significant because it's going to engineer willing parties to sell short. That selling short will flood the market with the counterparties to smart money wanting to buy it at a deep, deep discount. The other form of manipulation that takes place when it's bullish is neutralizing long liquidity. That means there's individuals that's probably already long or just recently bought near the opening price, and the drop down below the opening price will upset their long position. In other words, it'll just run their stop. Not to engineer them into a new lower entry, but to knock them out of an initially well-placed position. So we're seeing two conditions that are happening at the same time. The opening price and below it, when we're bullish, is knocking individuals out. That's right. That would otherwise be profitable if the market rally. And it's also inducing or engineering of short-term sentiment shift to bearishness by running short-term lows. Not only would we take out long holders with their sell stops, but traders that want to sell short on a stop, they would be placed in on the market on the wrong side. In other words, selling short in an otherwise bullish market. So finally, as we interpret this, the manipulation is we're looking how the market makers pair orders. By pairing these sell stops with smart money buying interest, we can see the manipulation cycle as it really is. A run below the opening to accumulate long positions before the big up move. And finally, the distribution cycle, where smart money pairs its long exits, selling out of their longs, with pending buy interest. Now that pending buy interest is going to be in the form of buying above an old high. That would be a breakout artist idea. They're going to want to break out above a previous high, and they would view that as strength, buying strength. Well, smart money will look to sell their long position to those breakout artists that want to buy above an old high, or those individuals that would probably try to sell short intraday. They would have a buy stop above an intraday high. Smart money would look to run through that intraday high and sell it to those buy stops. So their long end exits would be paired with a short-term intraday swing high. If we've seen a nice little retracement lower intraday before the close, that's where an area of distribution would come in. So we're looking at a reverse idea here. The open, high, low close with a down close. And again, this representation is a crude depiction of a daily open, high, low close bar. And we could see that same thing in the form of a bearish closed candle. Much easier on the eye, but we're going to take our focus back to the open, high, low close bar. And again, the opening price, much like we just said, but just for completeness sake, it is the initial value price prior to any imbalance. The closing price is the ending value price of that time interval that you're measuring. In other words, what time frame you're looking at. And if it's daily, it's the ending value for the daily range post or after the price imbalance. In other words, the movement that took place between the open and where it's now closing. And we have the range expansion cycle that is basically dynamic price imbalance. So between the opening price and the closing price, when we're bearish, this is what we would be expecting or anticipating in price, okay, a lower close. Now, in the form of power 3, what is accumulating? Well, from the opening, when we're bearish, short positions are building up. And who's building up short positions? Smart money. At the opening price, or just above the opening price when we're bearish, we would be anticipating manipulation. And what form of manipulation will we expect to see? Engineering long liquidity. In other words, we're looking for a quick stud movement higher to entice breakout artists that want to buy, want to break out, and they would be placed in on the wrong side of the marketplace. Another form of manipulation, this would be neutralizing short liquidity. In other words, those individuals that would already be short in the marketplace that would otherwise profit from the future coming decline, they are knocked out by having their buy stops tripped. So they're neutralizing their short position, and their short position being neutralized is a buy stop. So that buy stop that hits the market as a market order, smart money will sell to their willing buy stop. So in other words, if the market trades up to your buy stop, that buy stop becomes a market order to buy at the market. Smart money will be counterparty to that. They will sell to those buy stops, but their sell position is to ride it lower and make money. Manipulation in its truest sense is in this form when we're bearish at the opening price or above it. Buy stops are being paired with short interest on the form of smart money. And finally, at the end of the day, the distribution cycle is seen where smart money pairs its short exits or covering with pending sell interest. In other words, smart money is going to be short, and to get out of their short positions, they have to buy it back, and they will be targeting some old low. What would be resting below an old low? Sell stops. Those sell stops, once they're triggered, they become market orders to sell at the marketplace, which floods the market with sellers. And the best time to cover a short is when there's a flood of sellers in the marketplace willing to sell at a low price. And this would be the distribution cycle of the daily range. Okay, so what does accumulation look like in a bull condition or when it's bullish? It's not important that we zoom in here and see any of the details. I just wanted you to see the overall characteristics. In the green shaded area, you can see that there's a consolidation around the opening price, and that consolidation leads way to a decline, which gives us the framework for what does manipulation look like in a bull condition. Well, this is what manipulation looks like right before the market starts to trade higher, after consolidation, when the accumulation of longs are being made. The problem is you see that decline below that green shaded area as weakness. And who would be wanting to buy ahead of that? Smart money traders, okay, they have very deep pockets. And the market has a tendency of creating this fake move, okay, where it entices or induces the opposite mindset or sentiment. This drop down out of that consolidation when we're overall bullish is manipulation. It's knocking out short-term lows. So anyone that's long, they're knocked out. They can't profit from the up move. And it's also putting traders in on a breakout short, and they're going to be on the wrong side of the marketplace. And finally, at the highs of the day, we have our distribution where smart money exits their long positions by selling above an old high where buy stops would be resting. So those buy stops would be hit, floods the market with buy stops, buyers at a higher price. Smart money is going to sell their long positions to higher buying interest traders in the form of their buy stop being tagged. Okay, and what does accumulation look like in a bear condition? We have a consolidation and price moves higher, which would be the manipulation. Now, if you look at the left side of the chart, you see a double top. That's exactly where what? Buy stops would reside. Okay, lesser informed traders would have their buy stops resting above that. They would view that as a stiff resistance price point, and those levels are too clean. The market will, in fact, want to go through there, probe it for buy stops. Those buy stops are going to be triggered. Anyone that's short is now allowed to be profitable in the move going lower. So they're neutralizing their shorts by hitting their buy stops. Also, breakout artists that see that equal high to the left of the chart and the consolidation that move out of that, they would be buying that on a breakout or trying to buy strength in their eyes. Both are incorrect. And what we're actually seeing is the market driving higher to pair traders to buy higher or at a high price, and short sellers in the smart money camp, they're going to be selling short to those individuals that want to buy at a high price to make a profit as the market moves eventually lower. Towards the end of the day, we see the distribution cycle come in where short holders in the smart money camp are going to be looking to collapse their short positions. To get out of a short position, you have to buy it back. You have to look for an area to run below old lows. If you look at the original consolidation, 20 pips below that, that's where we see the low of the day form. It's exactly where smart money would be collapsing their short positions for day trade. And we see the ending cycle, their distribution. Smart money collapsing their short in the form of buying it back at an area where sellers below the market would be interested in selling. Overall, if you understand this concept, and there's lots more of information that's coming by way of my tutorials, you can look at the marketplace like this and see the original consolidation here in the green. The market reaches down below the consolidation into an area of liquidity, which is 10 pips below equal lows. Those sell stops are triggered where smart money would be buying. Once those sell stops are tripped, they're buying the low of the day. The market rallies up. We have an expansion move or range expansion up into a move of running 20 pips above the old high. Then their distribution cycle goes into the marketplace, and there's a complete daily range using the Power 3 concept that I've outlined here. So hopefully you found this teaching insightful. There'll be more built on this with the future tutorials. And until next time, I wish you good luck and good trading.
Good luck and good trading. Okay. Let's go back to the charts. Did anybody have a question over that video? Great. Let me go back to the hour time frame. I want to remark the entry of the week. Okay, I want you to think about what ICT just said about the open. We were bearish for the week. When the market opened, we push up. He explained why the market pushes up, right? It's to entice people into longs, right? This move doesn't look that significant, but if you're in this move, you pushed up about 80 pips, right? If you're in my group, you're probably buying to sell, right? But you know, there are a number of different ways you can play this, but a lot of people may have believed that the market was going to push higher than this point. So maybe they were trying to get long, you know, up into these equal highs here, or a 78% retracement. But, you know, we were just trying to buy at these 80 pips before you sell it, okay? We understood the assignment. We got what we needed. Then the market immediately flushes, right? And it moves down past our entry down to a low, all right? Pay attention to the times and dates that you see here, right? This is on a Thursday, we made this low. Once the market makes the low on Thursday, it trades back up past these highs and gives you chalk, right? On Friday. If you think about these concepts, and I'm going to play another video, right? The power of three concept, we were bearish, so we expected the market to move up first. We expected it to accumulate, to distribute at the top of this range. If we drop down to the lower time frames, you can see Wyckoff distribution playing out across the top here, right? Then you'll see the market flush. You'll see it pull back, right? Pulls back into an imbalance. It drops, violates these lows, it pulls back again, right? Pulls back to an imbalance again, flushes, right? So multiple entries, if you understand what you're looking for and how to drop down in your time frames, you can take advantage of these setups. This distribution range, right? This distribution range, London session, look at the time, 01 in the morning, right? This initial flush right here is like 1:15 in the morning. So this is around the ICT kill zone time. Concepts are working, you know, within itself. This push up, right? For it to turn around in the middle of the night. This is your Judas swing. The push up is a lie. It's a lie. So the market pushes up. Maybe you're in the New York session. You're winning. You get your entry down here, and you're winning your trade. So you go to sleep, and in the middle of the night, you know, around the start of the London session, the market reverses on you and pushes down. By the time you wake up, you know, at 6 or 7 in the morning, you're out of your trade. The trade is way down here. You missed something, right? Your analysis failed you. We're going short. The push up was a joke. So if you look at these different areas where you could have been a market participant and you look at the times, think about the kill zone times. It's all going to make sense. And this might take a little bit of a chart time that you're looking and you're paying attention, but the concepts are rock solid. And the reason that we use these higher time frames is because you could have been a market participant from the 4-hour time frame, right? You could have got in on this move and caught it on the 4-hour with this bearish order block. Your entry would have happened at 05 in the morning, New York time, and you didn't have to do anything the rest of the week. And you could have taken your profit, you know, right around the time that price crossed back over the moving average, which would have been Friday at, I can't see the time, what, 05 in the morning. So this trade would have still worked out for you on a higher time frame. But if you are a person who's able to drop down and utilize your time frames, you could have participated a little bit earlier, and maybe got several re-entries, several positions on the drop. Maybe you have gotten out closer to the bottom than you did here. But it works for all of us, based on our level and our experience. So this is the power of three that he was talking about. That's the concept. That's where we get it from. This next video is going to detail a few more of the concepts. Some of the things that I pointed out to you when it comes to time, and some of the other things like the retracements that you could participate in. For instance, this move down, it pushes back up, right? Look at the time of this 4-hour candle that it pushes back up, that you could have got an entry. Just pay attention to this sort of thing. And I'll let you, again, hear it from the horse's mouth. That way, this, starts to sink in for you. This is from the 2023 mentorship. It's the silver bullet. And, I'll just let him take it away from here. 20 minutes.
Well, welcome back, folks. All right, so we're going to be talking about my ICT Silver Bullet trade setup, which is a time-based algorithmic trading model for all asset classes. All right, before I get into it, let's discuss ticks, points, and pips, and the relationship to forex to futures. For an ICT silver bullet trade, the minimum trade framework should be 10 points or 40 ticks for index futures or indices. The minimum trade framework should be 15 pips for forex pairs for forex traders. Now, an amplification of that is this: framework is the best case price delivery that you expect to see, not your actual trade entry to exit range. So in other words, if everything were to be perfect, and you're not trying to be perfect with your entry, you're not trying to be perfect with your exit, if the entirety of the move that you foresee is likely to unfold next in whatever asset class you're trading, that range is the framework. But you're going to be looking for a trade within that framework that doesn't demand you to have the highest degree of entry precision or exit precision. Over time, you'll get better with both of those, entry and exit. But now, using a model, you want to have something that's a little bit more forgiving. So for index futures, if you're trading indices, the minimum framework is it has to at least offer the potential for 10 points or 10 handles, which is equivalent to 40 ticks. The same would be said for forex. The framework should be a minimum of 15 pips for the pair you're trying to trade. So if you can't work out a range move, at least 15 pips, the trade is probably not high probability. It would be better suited to be left alone and let it pass, or look elsewhere. 10 handles for indices is the same to me as 20 pips in forex. 5 handles for indices is the same to me as 10 pips in forex. So many times with my tweets or comments in my videos and whatnot, folks that reach out to me through TradingView, little messaging system they have there, I ignore a majority of everyone that sends me messages at TradingView. I just get too many of them. And the question that keeps popping up recently is, if I'm teaching predominantly presently at the time in 2023 in the YouTube mentorship, which is free, by the way, the question is if I'm looking for 5 handles of price movement in the E-mini S&P, what would that translate for those that are trading forex? That would be the equivalent of 10 pips. If I'm looking for 10 handles in indices or trading stock index futures, if you're a forex trader, you would be looking for the equivalent of 20 pips in your forex pair. So that way there's the the relationship between the two. These are essential frameworks to what I deem high probability ICT silver bullet trade setups. All right, so let's talk about, this is really the gem of this presentation, really, types of ICT silver bullet setups. Now, the framework for many ICT silver bullet setups are as follows, but they're not limited to: previous day high or low draw on liquidity, meaning yesterday's high, if we're bullish, there's going to be buy stops or buy side liquidity resting above that. We would be looking for a run to previous day's high. That expansion is the draw on liquidity for buy side. Vice versa, if we are bearish, we're expecting lower prices throughout the week, and we see the previous day's low as having sell side liquidity or sell stops below it. So we would look for potential setups that would expand down into that liquidity. Previous session highs and lows as draws on liquidity, meaning that, let's say you're sitting down in front of the charts and it's the AM session in New York. You would look at the high and or low of the London session that just passed and look to a run on liquidity or retest of those old lows or highs. Previous weekly high or low as a draw on liquidity. If we're bullish, we would look for a run above the previous week's high, or if we're bearish, we would look for a run below the previous week's low. Another would be returning to a current or old new week opening gap. So that would be treated as a draw on liquidity, or an expansion away from the current or old new week opening gap. And a classic ICT optimal trade entry, which has been for the longest time while doing this YouTube channel, that's always been the classic flagship pattern, but now we've seen many more models and approaches, so it can't be referred to as the flagship pattern anymore. I think the fair value gap has taken the throne there. Confluence of the 2022 ICT mentorship YouTube model, which I taught for free on this YouTube channel, meaning that your draw on liquidity could be a inefficiency above the marketplace when we're bullish, or a inefficiency below the price when we're bearish, which means that if we're bearish, we could be aiming for a discount, buy side of balance, sell side inefficiency, or some measure of fair value gap that would be below current price action. That would be your draw when bearish. Or if you're bullish, you would be looking for a inefficiency above current price action, which would be many times in the form of a SIBI or sell side imbalance, buy side inefficiency, or a variant of fair value gap above current price action. So you can treat that, or as I mentioned, all the previous ones above number 7 here, all of them being equally available in terms of probability if it is in the market at the time. Not all of these are going to be a factor. You know, there will be times where the previous week's high has already been rated that morning, and looking at it again may not be the ideal scenario. So it might require you to look at a higher time frame liquidity pool or inefficiency above price if you're bullish. So I could list a myriad of different scenarios, but I think this list is good enough to give the students of my YouTube channel a great deal of latitude. So that way you can look at the potential for any one of these situations. Not all of them will exist. And on any given day, not all of these will be in the charts, but most days, one of these criteria will be in play. And don't take my word for it. Go back through your price action. You'll see what I'm saying here is in fact true. Obviously, the main emphasis is determining the next most likely draw in the price action. So where is price likely to go to next? That's the number one goal for all of my students, is to focus on that skill set first, because all the entries and the exits and such, that is the least important thing, because you don't know where price is trying to go to from the time you're sitting and looking at your charts. And whatever analysis concept you use is probably going to fail you. All right, let's talk about our first ICT silver bullet setup and the time at which it forms. Now, again, this is a time-based model. That means these things are linked to a specific 60-minute interval or window in time every single trading day this pattern will form. It may not be in the forex pair that you're trading. It may not be in the futures contract that you're trading. It may not be in the asset that you're specifically looking at, but it does form every single day. First setup time is 3 a.m. to 4 a.m. Now, we're always referring to New York local time. So whenever I'm referring to a specific time, whether it be a window of time or a very specific time of the day, you have to have your charts calibrated to New York local time. Wherever that is, whenever that is in your area. If we're observing daylight savings time, then you observe daylight savings time. So that way it removes all the uncertainty, the confusion, whatever it is in New York, that local time, that's what you're using when you're charting. This is the London Open Silver Bullet. So what we're looking for is a classic ICT fair value gap to form between 3 a.m. and 4 a.m. New York local time. The factor that which you are going to lean heavily on is the skill set of knowing where price is going to go to. Okay, and it's not necessarily the bias. You just predominantly have to consider where the next draw on liquidity is. Is it going to go above the marketplace for buy stops or trade into inefficiency above current price action? If you're bullish, in this case, the market was bearish. It was looking to go lower, and there was an obvious sell side liquidity pool resting below that old swing low. And between 3 o'clock and 4, the market created a fair value gap. We had a shift in market structure below this low here. So this is your classic what? Optimal trade entry. Fair value gap here. The market shows the willingness to support this idea with the body staying inside that gap. See that? Now at 4 a.m. it does pump one more time just above it, but that's fine. It would have never stopped you out with the rules I teach with all of my models here, especially the optimal trade entry. The idea for this would be to look for a minimum of what market is this? It's a futures contract. So that means, does it offer the potential for 10 handles? So from here down to here, trading below this low, not just to the low, but to it and through it. So it's reasonable to anticipate a potential run of 10 handles. We don't require that, but going short inside that fair value gap, the formation of the ICT silver bullet, the entry is taken inside of that 60-minute window between 3 a.m. and 4 a.m. It does not mean that the trade is entered and is exited in the same 60-minute window. In other words, your trade many times will be held over the 4 o'clock hour and into 5 o'clock in the morning, and maybe even rolling over into the New York session opening at 7, 8 o'clock New York local time. But in this instance, we would be aiming for this low and the sell side liquidity resting below it. So does it offer from this entry here down to here at least 5 handles for you to book in profit? It does so. The framework was, could it get to 10? It could do 10. We don't require that. Shorting into fair value gap, covering at the old low, allows for at least 5 handles, and that's what the ICT silver bullet is. This is my actual model for my son Cameron. All right, the second one in our continuing list of ICT silver bullet setups is the AM session. Now this one is focusing on the 10 a.m. to 11 a.m. always New York local time. And let's take a closer look at this one now. Okay, so we are looking at the E-mini S&P once more. And the idea is between 10 a.m. New York local time and 11 a.m. we wait for when the market's bearish. Relative equal lows, there's sell side resting below that. We have a fair value gap, bearish. Fair value gap, it trades up into it between 10 o'clock and 11 o'clock. We can sell short there. Does it offer 10 handles? Well, from 41.46 or thereabouts to 41.36, that range doesn't even get us down into this low, let alone below that one. So it obviously meets the criteria of a minimum of 10 handles in framework. It does not mean you're trying to get 10 handles. It just means that it offers 10 handles. So going short here, collecting 5 handles, that could have been done inside of the scope of that 60-minute window. Not that you're trying to do that, as I mentioned briefly moments ago. The trade is many times held in duration longer than the window that the framework and entry is derived from. So it's not a in and out within the same hour. It means that you're looking for the setup to form to get you into the trade within the scope of 10 o'clock to 11 o'clock New York local time. All right, and finally we have our last ICT silver bullet here, which is framed on 2 p.m. to 3 p.m. New York local time. And this is the PM session ICT silver bullet setup. In this one here, we can see that we traded down into a higher time frame, 15-minute discount fair value gap, and you're encouraged to go into your charts to see that is in fact what we have here. Market trades down into it, shifts higher, a swing has been broken to the upside, so we have a shift in market structure and a fair value gap. So any retracements back down into that, look at the bodies staying inside that. The wicks did the damage, but the body's telling you from there to the story is told by the bodies. So it's telling you it's respecting the spot side imbalance, sell side efficiency, or fair value gap. Going into 2 o'clock, we rallied and we created a small little fair value gap there. The market drops down into that before taking out the relative equal highs, buy side liquidity, and or returning back to a premium sell side imbalance, buy side efficiency, or fair value gap that would be above the market here and here. So if it's going to rally here, the framework could be on the optimal trade entry here, and then taking the first fair value gap that forms inside of and reprices to between 2 o'clock and 3 o'clock. That's happening right there. So from here all the way up to here, does that offer 10 handles? Yes, it's actually offering 12 or more. So this entry here is a high probability condition that lends well to a run into inefficiency in the premium and to take buy side out as well. So that is a very handsome run there and trading between 2 o'clock and 3 o'clock. Now some closing thoughts. If you're new to my channel and you're seeing this, you don't have enough to trade this pattern. So you have to back test it while you're learning how to read price action and determine where the next draw on liquidity is going to be for the next price for whatever asset class you're trading. So don't be discouraged if it seems like it's just cherry picked and where it is, because I actually treated many of these types of setups either with calling it out on Twitter or mentioning it in passing while actually doing executions and recording it. So these patterns, these things form, and I called a few of them real time on Twitter last week, and many of you, much to my disapproval, because I don't like when you take the setups at a trade setup signal. I don't want you to view it like that, but many of the followers on my Twitter feed actually showed they took the trade I called out with using a silver bullet. So the pattern works. Is highly consistent. It's extremely high probability when you have all these factors in mind and they are present in price action. It gives you a rule-based idea to look for a time-based model. So time and price is being utilized here, which is where the focus of my analysis concepts and teaching as a mentor, teaching my students how to find something that repeats. You can't get anything better than having a specific 60-minute window of opportunity that forms every single trading day. Every single trading day, one of these setups are going to form. Now, if you don't have a plethora of markets to follow, ideally 1 or 2, that's why you're first learning how to do it. Even if you grow to a point of interest where you have a lot of markets trading, a lot of pairs or a lot of interest markets and such.
Okay, so I mean we've got the gist of what he was saying. Okay, you can find one of those setups at any given point throughout your trading. All right, he specified the dates, the times, all that good stuff. Now let's go back to the charts, and I just want to show you some of the things that he was talking about. I'm going to go to the 1 hour just because it's easy to see the time. Okay, if you see this time where price came up to the area that we anticipated price needing to pull back to, it was at midnight, right? 1 o'clock candle, you get a bearish 1 hour order block. 0.2, you get this push down that creates a fair value gap. All right, 3, 4, 5. At 6 in the morning, they trade back into the fair value gap, and you get the initial push away. The initial push breaks the swing low, letting you know that the market is going lower. It pulls back, gives you an OTE. You could have taken this trade at 0.9 for the push down, and then the market just collapses, okay? You don't really get another opportunity to trade until, I can't see, what time is this right here? 0. Can somebody help me out with the time?
Let's say 2 o'clock.
Okay, 0. You get another opportunity to trade. It trades back into the imbalance of this push down. You could have got an entry. We go down, we break these lows. It pulls right back up, creates equal highs, or it snatches the liquidity from these relative equal highs. This happens that I can't see that time, 0:09 in the morning, New York time. We run the highs from London session. I think he mentioned that too. The highs on London session, you had relative equal highs right here. We go and run those highs at 9 in the morning. The market collapses and it runs the lows that same day. Keeps pushing down. These are all different trading opportunities if you're not a swing trader. If you're just a person that comes to the market to pick trades out, you're looking to get active, or maybe you do have a swing trade, but you want to pick up some side action, right? These are sidebar action that you can get into while your swing trade is running. But the market pushes down, okay? The last opportunity we have is when the market really bottoms out here. It bounces, it gives us the bullish order block. If you're on the lower time frames, what time is this? I can't see the time because I got the captions on. Okay, this is the end of Asian session, the beginning of London, and the market pushes, you get that push up, okay? The push up creates the fair value gap that the ICT was just talking about at the last few minutes of that video. It creates the fair value gap. You can see we break these highs, the market is exhausted. This is the fair value gap that we're looking for when this market pulls back down. We're looking to get long in this fair value gap to take our trade back up. Okay, where are we trading this market to? This brings us to the current week. So instead of me doing the analysis, everybody should have the requisite information to analyze this exact pair for what they expect to happen. I gave you the first move, all right? This is called chalk. You'll hear this referred to as chalk. This is a chalk on the 4-hour time frame, I believe. So yeah, let's talk about chalk. Chalk is change of character, okay? The market reaches a low, the push back up breaks swing highs, right? That's called change of character. Once it breaks these swing highs, that's what we need to see as traders to let us know that the market is ready to go that direction. So if I put a fib from the low, from the swing low to the swing high, and I get my 78, I think my 78 is around the line that I have it at. That provides me my optimal trade entry. But remember, this imbalance, right? This imbalance is our key. This is what we focus on, because this imbalance is where the market is going to push into before it pushes up. And you didn't hear it from me. You heard it from Mr. ICT himself. So that's what we're looking for. This imbalance is going to trigger the trade opportunity. All right. So now when we drop down to whatever time zone that we utilize as traders to enter the trade, we can refine this. Okay, this is the 15-minute time frame I dropped down to. So maybe I'm looking for price to react at the 137.98 level. Maybe I'm looking for price to come down further to react at the 137.77 level. Or maybe I'm looking for it to come way down here to the last possible entry at the 137.50-ish area, okay? I can hear some of y'all thinking, well, how do I know which level, Todd? And I'm going to tell you, I don't know. You watch price. That's how you know. You're going to watch and see the reaction that price gives you at these various levels. But this is the reason that we say walk into the trade. But this is also the reason why, ICT never even gets involved in that. He tells you to put your stop below this level. And that takes care of everything. So what I would suggest is that you walk into the trade, which means if you're prepared to risk 1% on this trade, and that 1% is a 1.0 lot size, then maybe since we have 3 different areas of entry, you divide that 1.0 into 3 different positions, and you enter the first position at a 0.33 right here. And then the market pushes down, you enter the second one at 0.33, and your final is a 0.33. And all of them with the stop loss below here. So maybe you have them staged and you're asleep or you're gone, and the trade only picks up one of them and it starts pushing up. Well, it's going to pull back again, eventually, and you can add those other positions. I want to go back to just the picture, because you don't have to believe what I'm saying. The initial push up created the fair value gap. It's going to trade back to this fair value gap. Wherever your entry is along this fair value gap, you'll likely get an entry. Maybe it only pushes a little bit into the fair value gap and it picks up one of your positions. Notice how the trade goes up, it pulls back. Well, maybe that's not a pullback, but this is definitely a pullback, and it lets you in again. And this pullback is the optimal trade entry from this move up to this pullback. So this is what I'm talking about you're going to have several opportunities to have an entry if you miss the first one. So don't have the FOMO if you don't get your entire position laid on right here. What I'm asking people, anybody in the group who wants to share their screen, I want them to show us, predict for us where the market is going. Where can we trade this move to? Now, ICT laid out several factors and indicators of where we can probably take this trade to. So do I have any volunteers that want to do that? We can start with the weekly candle. Let me just share my screen because y'all aren't being team players today. I'll make the first attempt here. Okay, I'll do the very basic work. I'm going to delete this line.
I would say fib the weekly candle. Yeah.
Yeah, I agree with that. I would agree with that 100%. Now, if I'm just looking at this, right, without fibbing anything, I know that the next candle is going to open right here. And healthy price action tells me that this wick of this third candle needs to have a relationship with the wick or lack thereof of this candle, which tells me already, it tells me that we should see price push up 300 pips. Do y'all agree? Do y'all understand that?
See.
Yeah. Anything short of a 300 pip move is going to create what?
Imbalance.
So that's highly possible. It's highly possible. We didn't have an imbalance last week. And the reason why I suspected that we go to this level was because of this weekly wick. Now, we can have an imbalance, and it's fine if we do. But I believe that was Rosebud. Do you want to share your screen, Rosebud, to do the fib?
I'm on my phone. So
You want
I
me to do
can
it?
if you want me to.
Well, somebody, I want us to start by breaking this pair down. Like I've done some labeling, right? So
Mhm.
on my chart, when I have this stuff written down, you want to label. This is the old swing low right here.
Yeah.
Swing low right here, right? So whenever you guys are breaking down your charts, it would behoove you to make annotations. This low right here, right? I know we ran through the low, but when we fed back up, pay attention to what happens and what's here. Do we have relative equal lows now at this level? All this stuff is important to you when it comes to when you start to break down and understand the possibilities that can happen. Notice at this old low that there's an order block. That's that same level. There's order block.
I'm on my iPad. I can share my screen.
Okay, I mean, if you want to share your screen, that's awesome, and give us that weekly candle.
Okay.
This is exactly how I analyze the pair that I'm interested in every week. And you have your trade expectations and all that good stuff. Either the market follows your analysis or it doesn't. At the end of the day, we're the last line of defense. If it doesn't do what we think it's going to do, we can trade something different.
Okay. Can you see my screen?
Yes, ma'am.
Sorry. Okay. All right. So we are here. All right. All right. Yeah, we could fib. So fib in this candle, the current candle down. All right. So we see our 50 is here. Let me mark it. So price currently is, well, down here at this close, and then that's our 50. I wouldn't even, which is closest. I really would have started from here.
Can you mark
This is where,
the 50 to the 61?
okay.
I see you marked
Yes.
but
Yes, the 61 also. Okay, I will.
and the 78. I like to use a
And
box and then a line, but it doesn't matter. However you want to mark it on
Yeah.
your chart marker.
No, I'll go ahead and do that. All right, so I'll take this off.
The reason why we want to mark all three of those levels is because price can visit all of the levels or it can visit one of the levels, right? We want to look at what's at those various levels.
Okay, so that's the golden zone. And do you just want a line for the 78?
Yeah, however you want to mark it up. I mean, that's how I do
Okay,
mine.
I'll mark it.
Yeah.
And I will make it this color. So this is my 78. Okay. All right, so that's the 78.
Okay, now
We could drop down.
there you go.
So drop down to the daily or the 4 hour.
I would go straight to the 4 and after that, then maybe to the 15. Okay, so at the 4 hour, what stands out to you?
What stands out to me is that we are making our way down here to the golden zone and this first imbalance that's down here.
Put your cursor because I don't see. Okay, right. We
Okay.
talked about that move. I talked about that,
Okay.
right?
And
So,
then,
about your
okay,
golden
I
zone.
could start from here. So Yes, that's our golden zone. And also in the golden zone, well, near the golden zone here, we have another imbalance coming to the top side. So we have imbalances going right back all the way up to the top side. So we have that one,
Okay, so I'm
and
not,
we have this one above the 50.
yeah, I don't,
Sorry,
I
go ahead.
don't care about the ones below the golden zone because we're gonna assume that we're gonna get to the golden
Mhm.
zone. I mean, if you want to mark them on your chart, I'm not gonna discourage you from doing that. But for me,
Okay,
I only care about the stuff that's in the zone or at the.
okay. So, all right, so by the 78, there is your imbalance. And in the golden zone, there's an
And there's an order
imbalance.
block at the 78. So let's look
Yes,
at the imbalance in our golden zone, right? That imbalance is right after equal highs. You
yes.
see that? In my opinion, that is those equal highs are going to get taken out. They're not going to survive. So I can basically guarantee myself that from that imbalance down there that you marked up, the one that I pointed out,
Mm-hmm.
if I ruler that move from that imbalance to those equal highs, how many pips is that?
Just from the imbalance.
Yep.
Let's see, to just the equal those 272 pips,
So
74.
74, I can big joker guarantee myself I'm going to make 275 pips if I catch that move. So I'm in my head, I know I'm over 10% because I know I'm gonna get me a couple of entries and I know I'm gonna knock that trade out the box. Now, anything after this can probably be gravy, but me as a trader, if I could take advantage of this move, then I'm going to have a successful week. Now, after your zone, let's say it pushes up further than your zone, right? But before we talk about anything further than your zone, what I would really like to do is go back to the weekly chart so I can see where the zone falls on the bigger picture. How much of an imbalance is going to leave if we just make it to your zone there. I like this zone because you see the other wick that we talked that I kind of mentioned before.
Yes, that small one.
Yeah.
Mhm.
On the bigger,
I'm sorry, can you please point it out? I got in late.
Oh, this one right here. This wick. Sorry,
not
right here.
Oh no, go the green candle.
That one.
A little bit below it, Isha. The green candle.
Huh?
The green candle wick is opposite your zone. That's the order block.
Hold on.
Down
Let's see.
to the left.
The
Down,
green candle wick.
yeah, down and to the left.
Oh, okay. This one.
Yep, that one
You
right.
talking about that one?
Yes.
Okay.
On a
Okay.
2 week, if we go to the 2 week candle, that's your 2 week order block. And I know y'all gonna ask, how do you know? If I combine those two candles right there, those two green candles, and this red candle, just go to the 2 week, just hit 2W.
Okay.
Now, y'all see that?
Yes.
That's the IC forex clearly breaker candle. I'm joking. But this is what's important about using your time frames and kind of understanding where you are. This will be a sufficient pullback to keep going lower without a gross imbalance, right? And that other imbalance could be mitigated, some of the time down the road, maybe, I don't know, but it doesn't necessarily price. I don't want us to get fooled into thinking that price has to mitigate every inch of this imbalance. This is really your satisfactory mark. And in my opinion, it's your safe trade. You understand that?
Yes.
Tracking.
Okay, so go ahead and drop back down
to the weekly?
I would drop down to, we can go back to the 4 hour. Anything that we get as far as a buy
Okay.
over this point is, in my opinion, is bonus. But look, guys, this is why we buy to sell, right? This is why we participate in the buy up, because who cares if it keeps going? We're in the buy. You know what I'm saying? And for those of you who want to be profit hounds and you want to get every inch, you're looking at this all wrong. You're looking at this all wrong. The buy up is not the important piece. The sell down is. Now, if it takes all week to buy up, then obviously, yeah, the buy up is great. But we don't know how long this will take. Maybe this buy takes 2 days. And then we get that Judas swing Wednesday morning while we sleep in the middle of London session, you know, about 3 a.m. That candle changes and it starts selling. These are the things that you as a trader have to keep in mind, right? What time is it? What am I expecting? Because you have to have expectations. This is the anticipatory skill set that, you know, that Michael is talking about. You have to anticipate, or you have to have an understanding of what you want to see out of price. Like, we want to see price pull back into our zone to fill that imbalance for the long. Then we want to see price hit that key level, right? Where that green line is marked. That's what we want to see. We want to see it run those equal highs. We want to hit the key level. Now, if it hits the key level on Monday night, bruh, my anticipation is we're going to sell hard and we coming right back down to these lows that we revisited, you know. But I really think this is going to be a 2-day buy. This is what I would think, just off the top of my head, seeing the range. But I think that sometime Tuesday or Wednesday, we'll probably get to this level, and then we can sell the rest of the week, like we normally do when we look at these weekly candles. It normally buys up first or sells down first, and then the second half of the week, it does what it does. Just like he explained when he was talking about his power of 3. So I don't think that this will be any different, but we just have to pay attention to what time we reach these levels, right? If we reach the levels before Wednesday, right? If this goes to 274 pips Wednesday, then we should all probably think that we're going to get a sell move. You know, me and my brother talked. I mean, maybe this buy move takes all week. I don't think it'll take all week because of the monthly count. You know, here we in week 2 or going into week 3. I don't know, but going into week 3. So I don't believe we have a week we can waste by buying, you know, not this month. But, you know, we don't, it's the middle of the month, so I don't want to make any rash guesses. We don't have to do that. All we have to do is catch these 275 pips up, and we can make other decisions after that. Does anybody have any questions?
Lousy. Get them, Todd.
I'm just saying, like, this is a move that we can anticipate. There's a trade that you would call wavy, OG. If you look at NJ did what ICT was talking about. It went back to equal highs.
Yeah.
NJ went down, I want to say 230 pips, and went right back up those same 230.
Yeah. Anticipation is everything, man. Like,
so if you look where this started, it's actually a little bit higher. It finished exactly where it started. If you go right over where NJ started, it's finished a little bit higher. NJ started probably that red candle, the first red candle that pushed down. Can you hover over that price? Is that Sunday at 1700? Right above your 4.
Right here. Okay.
Nope. It's below there, but hover over those.
Below?
Yeah, it's below that area.
You talking about this one?
Hover over no, see those red candles with the exhaustion? Right? You see the number 4? is to the left of the number 4.
Mm-hmm.
Hover over the candles to the left of the number 4.
Yeah, so,
No, but
okay, are
without
you
the
talking
green,
about these?
yeah, but without the green line, I just need you to hover so you can see the time. You got to put the green line.
Oh, okay. So like this,
Yeah, now go over to
can you see it?
the bottom of the screen. We want to see Sunday at 1700. Which one of those candles? That one, right?
Okay,
Is that the 1700 candle?
yes. Yes,
Okay, so that's market open. See how it pushes up first? Right into the imbalance that it left, but that's also a Judas swing.
Fire.
It pushes
Come
right
on.
up to the imbalance and it sells off. Then it had the gall to buy right back up to the same spot and close completely that same imbalance.
This is the beauty of it, folks. This is the beauty. It goes to the orders and then it drops. This is what's happening on the 6-month candle right now.
Yes. Yes. And if you notice, it's still in play for the sale. All
Yeah.
that is if you look to the left, right there, bless you, right there, it says New Zealand dollar, right under the Zealand, that's a swing low. Price breaks that low and 2 other swing lows on the screen, right? And it pulls right back up. So if you fib from the very top of this move to the bottom, and that pullback is probably, close to a 70% pullback, the highest of the high up there. You fib the higher. Yep. Money, boy. So if you don't want to get into a pair that's going to be playing around, like this is going to fail. This pair is in a different spot than UJ. This pair already pulled back up. UJ needs to do the pull up. This pair pulled back up and it's ready to sell. So you just kind of have to understand, what's going on with your pairs.
And I know that people get, they're fairly new. They're not seeing this. They need somebody to tell them this stuff, which is cool. But if people get busy, you got to be able to see these things. It's so special. It's a situation where you have to have candles under your belt. It reminds me of playing golf and having to hit so many golf balls. Once you get a certain amount of balls under your belt, then you just see golf differently. It's the same thing with the chart, the candles, the amount of candles that you get. Are you getting everything out of the candles that you see? When you have this light bulb click and you start seeing these things, and then you want to see it again and again and again, eventually in the market, there's going to be something that there's not going to be anything that you haven't seen, right? That's how I feel right now. There's not much I haven't seen. I haven't seen a black swan event. That's what I want to see. I want to see this thing crash so that I can say I've been through that. So I know that when it happens again, I know what it looks like. I know how it sets up. Like, this is all a forward test. You got to get into your forward test mode. But you have to be anticipating something, right? So that's how forward testing begins for people that are, they've had enough candles under their belt. They're looking for things that are specific when it adds to your trading plan.
And all these concepts are the concepts that ICT talks about. This is not a foreign thing. And before this happened, I didn't know that hey, this is going to happen this week. But you can understand and you can see what happened. When you broke that swing low, you start getting your retracement. You have to be able to go to the chart and fib this down move and say, okay, the retracement might be 230 pips or 250 pips. And the reason why I know about this is I'm in an NJ trade in one of my accounts. So what I had to do was, hey man, this is not going to be a short retracement. This broke the 4 hour, so I had to go fib the move up. And all I did was double the lot size for the move up. And you know, if you're going to trade a currency pair, we have to be responsible enough to go and look at the charts or set our alerts at the key levels, like the swing lows, you know, as they're being broken, because we have to be able to do a quick analysis to see if the pair is still good. Hey, did it hit the level that I thought it was going to hit? You know, what's going on with the pair? So the reason why I wanted to play those videos is because y'all hear me say it every week. And, you know, I got it from the video. When you go and look at the video and you hear ICT talk about things, you're going to pick up maybe something different than I picked up, you know, like different things resonate with me than will resonate with you. So the objective is for you not to hear the things from me. Well, you'll hear them from me anyway, because I'll talk about them, you know, on these calls, but you can hear them from the source. And I just want to be able to show you, you know, on the chart, you know, what he's talking about, where the price has been. And in this case, everybody has a chance to see what we think that UJ's move will be in the coming week. And we can do that with any pair that you guys want to do it with, or you guys want to trade, you know. You know, but you guys have to be more vocal as far as, hey man, let's look at this, or let's do that. You know, I missed Leandra's session yesterday with the back testing. I was trying to catch that, but I think that's a very important piece, you know, because going back and looking and seeing what happened, and then, you know, you got to take notice. Hey man, what time did this happen? You know, does that mesh? Like, did it feel an imbalance? You know, like if you look at this move up from NJ, price never pushed back into that imbalance. So if you're waiting for price to push into that imbalance on this 4 hour chart, you'd have missed the move. But on the lower time frame, you could have caught it. So that's another thing that we have to get better versed at, you know, utilizing our time frames. You guys have any questions? Brett.
And remember, these are the basics. You have to have this. You have to have this part. It's going to take time, no problem, but you got to know what you see. You got to know exactly what it's telling you. Every time. That helps your anticipation. You have to know both biases. If you don't, you're not digging enough. You need someone to guide you, and that's cool. But these are the basic things to catch an entry that's going to give you pips. This is how you do it. There may be different views and all that, but when the time is right, everybody's anticipation should be the same, because you're in an area of importance. You have to know where these areas are. You don't want to make any moves until it gets to that area. So it should be already marked up. It should already have an alert on it. Everyone's alert should be going off at the same time. You should see it. Then people wonder, like, where's everybody at? They own their chart. they take care of business. That's where they at. All right. You can't wait for someone to tell you. You have to see it. And you have to know how to get in and out. Because if it flips on you, we're working the flip. We're not just letting it destroy us.
Yeah, or at least just like try to map it out best you can, and then like put it in the chat, and like we can come in and help.
Mm-hmm.
And by us coming in to help, you know, it helps make everyone better.
Yeah.
Everybody, you know, because everybody in the group has some value. They have something to add. And if not, why the hell are you here? You know what I'm saying? Like at the end of the day, man, we created a community to have people that do the same things that we do, you know. we got a couple of indices traders that trade indices way better than me. They trade circles around me. I don't trade UCAD. Rose trades UCAD. But my point is everybody has a niche and everybody has a purpose. And I get it. The majority of you guys, aren't on the same level. They don't have the same chart time as I have. But it's only a matter of time before you see and you pick up on things that you see and pick up on. And you're going to be great at whatever it is that you do. And you're going to be a key contributor. That's why you are here. Our community will only get stronger, and the trade opportunities will get better and better, with everybody who kind of comes to the table and starts pitching in. Because these situations and these scenarios are going to repeat themselves. Like we're going to have fiscal tightening, where we raise interest rates. Then we're going to have fiscal loosening, where we lower interest rates. We're going to have, stock market crashes. We're going to have job situations. We're going to have housing bubbles. And the more that we trade these and the more experience that we gain, the better we will be. And we'll have 5 people saying, hey, don't forget about this. And hey, this is what we should expect whenever there's uncertainty in the market. Hey, this is what we should look to trade today. Right now, we don't have a lot of people that come and blur out the information, even if they know it. And, I kind of want to make this a safe zone, man. Blurt it out, like say, hey, man, we should probably trade gold today. We should expect gold to soar today because the dollar's dropping. Hey, we should look at the indices today because that's what we need out of this community if we want to get to the level that I want us to get to. I want to be able to forget about things and somebody else say it. Yeah, I need to look at that. Because the trading opportunities in all the pairs it's a vast number of things. And maybe I'm looking at UJ when I really should be looking at gold. Maybe there's a better opportunity. There's lower hanging fruit.
Well, hey, man, you probably should look at the indices for a sell next week.
Is that my better?
No, that's mine.
I was going to say, mine is plugged in.
So is mine, but this hotel is horrible.
Yeah, you might want to plug your veteran.
It's straight into the jack. I don't know why it's doing this.
You better turn that light switch on because your computer about to die.
Is that what it is?
Probably.
I don't know. And I tried it too. Yeah. Mm-hmm.
Yeah, you're on 9%. It says it's charging. Who's trading something different? Did y'all take advantage of the USDJPY last week? Yeah, we talked about that dirty dollar drop last week.
Why do you look like this?
CAD did the same thing. It almost recovered the whole sell.
Yeah,
Like it's like halfway.
CAD dropped hardly with the dollar. Huh?
Hey, that was probably Alicia's clone. Who is this clone?
Yeah.
I don't have a clone. People are weird.
Who cloned your name? What happened?
Wow.
Yeah, I have no idea.
Want to be you bad. That's crazy. I know how.
Hey,
Actually, weird.
who wants to Marv, you traded NU?
Yeah, I traded NU. NU had a nice setup on the 4 hour, came back to the 78 zone, and boom, shot up.
Yeah, that's your OTE. That's the same thing that the ICT was talking about. That's your silver bullet setup.
Yep, loving it this week. Can't complain at all.
Yeah, I think we should expect the dollar to retrace, and then it's kind of funny because this week it should retrace, and then next week they don't raise interest rates. I mean, it's all setting up for them not to raise interest rates because that should be another week of drop.
Yep.
It'll probably be a hard drop when they don't raise interest rates again. Yeah, then the indices should go to the moon.
I got played a little bit by GA though this week, but it's all right.
Yeah, GA went a little bit higher. That's another thing.
Yeah.
Let me just share my screen. Since y'all
I think
don't want to play.
when we looked at the ICT, the video you played, you did say you would overshoot about 30 pips, not sometimes.
Yeah,
So I might have
it's
to
true.
go over that video again.
That's true, but I think that even more than that, just because we anticipate something, we still have to wait for it to play out, right? We had this down move. It never broke the lows. It just pushed up higher. And if you look at it, it never broke any lows until this candle right here. This candle broke these lows, and now it pushed up. There's an imbalance right here. It's pushing back up into the imbalance. There's another imbalance here. So if I'm waiting on GU, I'm probably going to fib from here to here and look for an entry somewhere around these lines. That makes sense?
Yeah, that's what I've got as well.
That's how you do it. There's no way to do it. You have to do that. That's what's not cleared. Once you understand that part, you don't have to worry about anything but what needs to be cleared. And then you try to catch that. It can go higher, whatever, but that's the area, right? The premium price, the OTE, that's what that is. You got to know how to mark that every time, any chart, anywhere. You mark the area that has not been mitigated. Exactly. And you let it go, let it peak out so that your stop loss can be tight.
I agree 100%. But all of those trades that we anticipated that was going to sell, those, especially the NZD pairs, like GN and EN, I mean, we finally got some cookage out of those pairs. I mean, they started moving with some authority, like I always say that GN is like an indice.
Yeah.
I mean, this thing came down 300 pips after the bearish 4-hour order block, 300 pip drop. Now you can see the chalk forming where it's going to pull back, and you can fib this move. There's an imbalance. You can pick up a sell trade somewhere up here to push lower. So it's just one of those things that once you start seeing it and you get comfortable with what you're seeing, then you'll understand what to look for, and you can just wait on it. You don't have to rush.
What's crazy is it already gave you a map. It told you it did it before.
Yep. It
broke through, but this time it might not break through. You got to still use the same setup. This entry is at the same area. You would have did it the first time, it would have broke some resistance, and the move wasn't correct. This time it may be correct. It's gonna go there again.
Right. Well, you can see we broke this swing low, right? Now we're going to pull back. The next swing low will be this one, then this one. So if we look at the 6-month candle, we see what's happening, guys. We went higher, right? Remember what ICT said? Hey, if we're going to go lower, we're going to go higher first. We took out this 6-month high. We took it out. We wicked past it, came right back. Now we're doing what we said we was going to do the entire time. Here was my target. Ain't nothing changed. It's just, hey, ho hum, we doing what we do. We got to retrace. It's got to happen. So, you know, man, I don't know about y'all. I swear, like this is what for me. This is it's easy trading. This is easy trading. We wick the high, push back down. This is the area that I expect us to touch based on that 6-month pullback. So whatever, however you guys want to trade, as long as it makes sense to you and it stands on solid principle, that I would stick to my guns. And in my case, you know, I knew that we'd get sales. We don't know when. I don't know. I can't tell you exactly what time it's going to pull back, but we know what to look for. We know the signs, right? Once price pushed up, this was our target, these highs. Once it went past that high, you know, that told you everything that you needed to know, because that's where the liquidity was. And it went past it. What time of day is this? I can't see the bottom of my screen. What time of day is this?
09.
New York.
Hey.
Then it pushes down, pulls back, gives you an OTE from the top position right here.
And
from catbird, it gives you the OTE and a catbird position.
Goes right down an order block. All right,
Right.
you ain't missed nothing. Just let it tap you in.
Yeah, but if you were anticipating that we was gonna run these highs,
yeah,
if you was anticipating that, you got catbird. As soon as it broke, you would have sold. You know, like, hey, I'm catbird because I know it's selling. Ooh. So, look, man, we are on the precipice of greatness, man. Like as a group, and our time is coming. We just have to keep showing up, because this stuff is happening over and over. Just like OG says, it happens every week, every month, and now, you know, it's just a matter of us recognizing the setups for what they are, and recognizing the trades for what they are. If we're bullish, we're bullish. If we're bearish, we're bearish. But we want to be bearish, you know, or bullish with a purpose, you know, not just because we believe, but we want to be bearish based on the concept, or bearish based on the idea that, hey, this 6-month candle is pushed up. You know, we went 1,000 pips on GJ for 6 months. We know it needs to pull back. So that way, at the top of this range up here, we could have got short, and then GJ tumbles and pushes down. So if you look at everything that happened, I'm not even actually trading GJ, but I had the swing lows marked up, and it was equal lows right here. Why did we wick past them before we pull back? You know, like, it's to be expected. We broke these lows, we retraced, right? Now we look for a push down. So all we have to do is stick to our guns. Everything is going to happen the same on these pairs. Once we break the swing lows, we pull back, right? We'll get another push down. We have a long way to go. We have a long way to go on these sales. We got to get way down here. So we can just trade it. You know, every time it pulls back, we can get in for the sale, so on and so forth. These things have pushed up for a long time. If you look at where it came from, and the drop normally happens a little bit faster than the push up, but you know, we have a long way to go. If we look at that 6-month candle, I believe it was close to 1,000 or 2,000 pips. This candle is 2,700 pips. So just to pull back to this zone right here is 1,350, and we just made the first little blip. Now it retraced. Now we'll be able to get into the second move. You know, all we have to do is make a decision, choose a pair, analyze a pair, and trade it. And if you trade it, or if you analyze it and mark it up based on those concepts, you know, any one of those silver bullet concepts, you're likely to have a greater level of success than if you're doing it some other way. Any questions? This is a new 2-week candle, guys. We starting fresh. We starting fresh on that 2-week candle.
I
So-
have a question.
Yes, ma'am. Oh, I'm glad you said something else because I want to talk to you. But go ahead.
We can talk in private.
No, go for the group. Yeah.
What I was gonna say, ask, because I came in late. Did you say silver bullet meaning ICT's 2023
Yeah.
silver bullet thing, or
Yeah. Yeah. So,
so
okay.
how? Mhm.
Okay. Let's talk about these. So the silver bullet, what he's saying is, there's 14 or 15 different things that he's taught over the years that you can take and look for as far as setups, in these time frames. We can look for OTEs, which is basically a 78.6 pullback. We can look for equal highs to be ran. We can look for imbalances to be filled and take a trade from there. These are all concepts that can be silver bullets. As far as silver bullet is a pretty much guaranteed kill, right? The trade is going to come to fruition. So there are several different things that he's taught throughout the years that you can look for to execute a trade setup. And then he has a time based around those concepts. If you understand the ICT kill zone, which is basically the beginning of every session, you will do well, when it comes to finding these trade opportunities. Does that answer your question?
I think so, yes, thank you.
Okay, I was going to ask you about your favorite trade. So you see why I don't trade FJ? You see what FJ is doing? Have you been trading this?
No comment.
I'm asking, have you traded it? Now, yeah, if you've traded this, you're probably like mincemeat because it's doing its own thing. And there's a good reason it's doing its own thing, but you're getting like no movement out of this, and you're rich if you traded any other JPY pair. Like, do you understand why though? Anybody? Yes. Yeah. Well, they're safe. Like JPY is a safe currency, and CHF is a safe currency. So when there's unrest or unsettled, we have an unsettled market. JPYs get strong, but so does the CHF. So where are you going to trade this to? Every other JPY pair is dropping, except for this one, So to me, it's the worst pair to trade. Look at the move that you got out of this pair in a week. It went up. Every other pair that we got in sold. This one, you'd have bought. Everybody else been making a killing selling it. If you had just bought this up and held it, you'd have did all right. But you still didn't make as many pips as the person, unless you traded it from this very bottom to this very top. You didn't make as much as a person who was short in those other JPY pairs. So it's nothing wrong, per se with trading it, but you have to understand how you're going to trade it. And in my opinion, it's just a lot more tricky than the rest of the JPY pairs.
Yeah, it's a scalper's dream.
Yeah, if you're trading this, you me. You're a lot better than me. I ain't got time, man. I'd have broke my computer trying to trade.
That's disgusting. It is disgusting. Like, it's for scalpers. That's what this is for. Like, if you want to be a scalper, this is where you're at.
Yeah, what a horrible 2 weeks.
Yeah.
The rest of the pair.
It's great to have this conversation about why, right? You You take this Chef JPY and then you put up NJ or GJ, and it's way back down into its lower structures. Like didn't do it.
Like these pair push down and pull back up. Every pair except for UJ has retraced, pretty much that retracement we were talking about. But in the FJ's case, man, FJ went half the distance down and all the way up. FJ it didn't stop here. It went all the way up here. So it's very nuanced, it's not low-hanging fruit if you ask me. That's why I kind of discourage people from even bringing it up, because it would get you killed. Whereas the other trades or the other pair offer, in my opinion, a greater opportunity for you to actually make money.
So if you're not seeing that, it'll take time. You'll see it eventually. And that just means on that specific aspect, you have now come to the light. You have graduated the reason why you don't trade FJ, or the reason why you do want to trade FJ. There has to be a reason. There has to be intention on what you're trying to accomplish there.
If I'm trading a pair with a C and a J, and it's gonna be CAD J, not FJ. Oh my God.
So I got a video that I have to do about the spreadsheet that we developed. And then we're going to put that in the group also. I want a time stamp on it. So I don't know if I should do it here because it's already being recorded. So we could probably set that up for some day moving forward and get that video in traction.
Yeah, let me know.
Yeah. And then I'll put the spreadsheet in the group. And also I need to put my Zoom meeting in the group too. So there'll be 2 Zoom meetings available. So if people are doing one thing in one Zoom, the other people can go on the other Zoom and talk about whatever else they want to talk about.
For sure.
I don't know how to do the settings on it, how it just runs. People just jump in.
Yeah.
Are you referring to the quarter spreadsheet, OG?
Yeah. And this is Tony, y'all. This is from my group. She's our IT specialist.
Tony.
Keeps me on my P's and Q's. How you feeling about the spreadsheet? You adding anything to it?
I did. I want you to look it over. You like the spreadsheet better than a doc sheet, right?
Yeah.
Yeah, I do too.
So we went in and we created our own indicators on TradingView. I couldn't publish them for some reason. I thought if we changed it and put our own fingerprint on it, that it would be fine, but they blocked me from distributing them. So the goal is to get all the indicators that we're using, the basics, and put them into one indicator to where you can turn off certain things you want to use or not use. We'll put the EMAs in there, the RSI, the fractals, and then you can toggle and turn on what do you want to use or what you don't want to use, and everything will be automatically set up. Hopefully we can publish it. But if not, and we can keep them to ourselves, we can do that too. So it doesn't matter.
Yeah, they flag when you publish things.
Yeah.
Because it's essentially a copy of someone else's indicator. So they act like it's like a copyrighted. Did you
So
try? You're welcome. Did you try the smart money concepts?
No.
I have a question for OG.
What up?
Do you have a certain time for your Zooms or a certain day? I mean, like
Well,
a schedule or something already, or I'm not
before
sure if I missed it.
I used to do Zoom meeting. I used to be in the Zoom meetings and just be on mute, and then people would come and go. Like we got to the point where we were in Zoom meetings for like 3 or 4 days straight, active. And I don't mind doing that. Like I was kind of tied up this week, so I've been a little distant. But for the most part, I can stay in a Zoom meeting all day long, and people can just come and go. My goal for that was that us people on the West Coast will have the Zoom meeting for our day, and then people on the East Coast or people on a different UK or whatever can come in and take over the Zoom and just be available, right? And just go over concepts always, and we can pass the torch from one time zone to the next, and somebody's always there. That's how I view it. But people see it'll wear you out, right? So I'm kind of beyond that now. I don't have a specific time, and especially this lends a hand to the fact that your trade happens when it happens. It's not necessarily going to be a specific session. It could be, but I don't care about the session. I care about when it hits my number, right? So that's when it's time to go to work. That's why I keep calling it that. You got to know both biases. When the market gets into that level of a sell or into that level of a buy, you have to know that it's there, right? So there's no time. It does it when it wants to do it. So if you start moving in that fashion, you'll be ready when it's time. And then you can build on that. Okay, well, what time is it that it keeps doing whatever I need it to do? That's something that you have to continually walk with your pair, marry your pair, and understand when those times are. And then you'll start developing your own schedule on when you think the moves are going to happen. So that's lends a hand also to when do I do the Zoom meeting? I have to be available all the time. I can't do a specific time. It's time when it's time. So and that's why I would stay in the Zoom meetings all day, because if people need some help, I'm there. I'm ready to help. I am in a position to where this is my job, right? I own it like that. So I got to be available. Now that I have 100% service connection, and that's good, I pay myself. I don't need no one to pay me to be available. This is what I do on a daily basis. So I'm available, all right? If you have to pull me to do a Zoom meeting, shout it out. Let us know that that's what you want to do. We get in there. And this is why I like to do things in the open. I don't be hiding. I don't be side chatting. I don't know. Do it out in the open, because people have the same question that you have, and help us help you. But to help us, we have to do this on the outside so that people can see it. That's my thank you. That's the thank you can give me, is by doing these things out in the open. Because people want one-on-ones. That's cool. We don't want nobody else involved. Well, that's not pay it forward. Paying it forward is being available, whether you're the teacher or the student, to get this information disseminated, because people have the same questions. They just don't want to ask. At least you want to ask, right? But don't keep it to yourself. Let it be open and free flowing, right? So everybody can get something out of it on everything we do.
If y'all need me, you can cash at me $800. I'll put you in a VIP.
Bro, I swear, boy, they be doing it, boy. Hey, just get a little, you know.
For a nominal fee of $800, you can get in the VIP chat where I'll be more accessible.
Predators, boy, I tell you, they can't help themselves. It's an addiction.
They make it big, but they ain't got to trade at that point. You know, you got 500 members, and they paying you $800 for VIP. Yeah, come on, bro.
Hand quick eye.
Yeah, that's crazy.
I'll show you everything you need to know.
Yeah, at the end of the day, this is just repetition, man. Like we're doing the same thing every week. And, I think that more and more people are finding success with doing it.
Yep.
It's just going to take time, like walking or crawling or learning the language. You just keep studying and keep showing up. Your trading gets better as you get better.
Sometimes you gotta listen when not to trade fucked up hitters.
Oh, yeah, as long as we ain't trading FJ every week, I think your journey will be shortened.
But talk about it. That's what I say. Talk about it. Talk about your FJ trades. It ain't gonna look pretty, but we'll see you graduate. We'll see you graduate into why you shouldn't be trading that pair.
Yeah.
You're either be successful or you're not. Chances are you're not. So you got to talk. And then you'll start hearing what you're saying, and you'll be like, "What the fuck am I doing?" Exactly.
Yeah, everybody else talking about they made $1 million this week. And you got Ginsu, by FJ.
Okay, I get it. Thank you.
Hey, F, I love you, girl, but don't trade FJ. Stay away from FJ. Hey, it's another CJ pair that'll pay you a lot better.
And we have fun with it. Always having fun with it. It's not fun to get wrecked. It's not. But you have to have short-term memory. You're graduating, right? It costs money to make money. We want to streamline the learning curve. We don't want, I lost what, $17,000 in the beginning. Got that all back, right? I had to learn, right? It cost me some money, right? You got to know that it's going to do that. And you got to get through that as quick as you can. Get to profits and get to the next stage. Like, that's it. We're going to take hits, no problem.
Easy E used to say, the bigger the cap, the bigger the pillar. Like,
if we really would have fun with the banter, boy, people be leaving this group.
no.
Oh, gee, don't go there, man. Don't go there. People don't like it, man. Don't go there.
Yeah.
I know firsthand, man. I know firsthand.
I didn't chase so many people away, boy. I'll be on their neck. They be mad at me, boy. We gotta talk. Let's talk about it. Keep the market. Don't play. The market will destroy you.
Especially when you take an L, that banter especially get a little rough.
That's where the money comes from. That's where the money for the profitable traders comes from. It comes from the death of
from the carpet burns, huh?
Yeah, hella carpet burns. Liquidity. People becoming liquidity.
Becoming liquidity. Well, either spot it or become it. Let me stop recording.